Investors should observe the Federal Reserve's funds rate, which is the cost banks pay to borrow from the Federal Reserve banks. By increasing the federal funds rate, the Fed makes money more difficult to obtain, effectively lowering the money supply. This helps control inflation, which occurs when too much money chases too few goods, causing price increases. A ripple effect ensues when banks don't borrow as much from the Fed. It starts with banks increasing loan, credit card, and mortgage rates. Consumers have less money to spend, so businesses see smaller revenues. Borrowing also becomes more expensive for businesses. They don't borrow as much and must pay extra interest on their loans. They spend less, causing profits and growth rates to fall. If a company cuts back on growth spending and makes smaller profits, its estimated future cash flow will drop. This also lowers stock prices, which could potentially cause the market to fall. Most investors don't want a declining market. When expectations for growth and future cash flow decrease, stock prices don't appreciate as much, and owning stock becomes more risky. Investors expect risky investments to return a risk premium, which is the return above the risk-free rate an investment should yield. But remember, a higher federal funds rate also increases interest rates for safe investments like treasury bonds, making them more desirable.